Professor Feldstein, we're up, but we're nowhere near where we need to be, are we?
No, and they should have started 2 or 3 years ago, and they can't make up for lost time by jacking up the rate at a very fast pace now without...
Why can't we do an Arthur Burns and not go measured quarter point, but go more, say a 3/8 of a point move?
That would be okay. But if they were to say, well, if we had started 3 years ago, we would be up not at 1.25 now, we would be at 3% now. So why don't we just jump to that? I don't think we could do that without really upsetting markets. But we've got to get there. We've got to get there. And the danger is the equity markets are not going to like it.
But so far, Professor, the equity market has been absolutely fine, right? We had that hike. It was well communicated. We didn't have the temper tantrum that we had last time round. So why are you worried for the next 12 months?
Well, because I think the equity markets are priced way out of line with historic experience. The S&P price-earnings ratio is something like 70% higher than its historic average. If it goes back to a normal price-earnings ratio, that would be a very big drop, and it would cost investors, households, $10 trillion just for that one-time correction. So that would be a serious impact on the economy that the Fed wouldn't be in a position to offset.
So, Professor, are you telling me that you believe equities or even bonds are a bubble? I mean, we've heard Chair Yellen, discuss that in the past and being worried about that.
To me, the short answer is yes. A bubble means that they're at a price level where getting back to normal cannot happen without some people being seriously hurt in the process.
The hallmark, excuse the plague, folks. I've got the plague. I'm trying not to give it to Professor Feldstein. The hallmark of Chair Yellen's time, and her voice would change. She'd get that Brooklyn accent when she'd say the word slack. She'd get upset about slack. Define for us her effort to be patient, to pick up the job slack that was in the economy.
Well, she's done a great job of bringing down the unemployment rate, inducing increases recently in labor force participation rates. So she gets an A for that. Really good performance. On the other hand, they haven't paid any attention at all to the impact of all their policies on equity markets, real estate markets, bond markets.
So then what should Chairman Powell do to begin to look at what we see with quantitative tightening and what we see with the asset bubbles that many people are worried about?
Well, as I said a minute ago, they cannot roll back the clock and they cannot catch up immediately for the failure to raise rates gradually starting 3 years ago. And that's what they should have done.
I mean, within this and within what they should have done, I want to go forward with Chairman Powell. And so much of this, I would suggest, is language. His first speeches are critical, aren't they?
Yes, but all he can do is talk about what they're going to deliver. And what they're going to deliver is going to be more of what they've been doing recently, gradually increasing 3/4 of a point a year.
Where's the inflation? Where do you see the inflation right now?
I am less worried about inflation than I am about what's happened to asset prices. I think the real problem... That's
an implied inflation,
it's an inflation not in the prices of goods and services, but in the prices of assets.
Do you suggest then across all central banks as we end the experiment, what David Rubenstein at my panel in Davos folks called the science fair, the science fair of quantitative easing? Can we do that with a public figure has to say, yes, we can do this. You're not a public figure right now. Do you have confidence we can do it with stability?
No.
What will occur then? Within the instabilities, what will occur?
I think the real problem is that the financial markets are fragile, and therefore the economy is fragile. Look at what's going on with the European Central Bank. Interest rates at 0 or negative interest rates.
But we eased the 5-year yield back to 0% this week in Germany. Can't we come out of the negative rate regime in a constructive way?
They can do it, but what's happened as a result of all these years of 0 and negative numbers in Europe and very low rates in America
Yeah.
has been an explosion of asset prices that I think is not sustainable.
Is this criticism because Draghi went to MIT and not Harvard? Is that what this is about?
Not at all.
I'm
Not at
kidding.
all.